Hey friends, welcome back to the channel. My name is Sanji and in today's video we're going to go through some common investing mistakes. Now it's not easy to admit when you've made a mistake, and generally the idea is you admit it, you learn from it and you try and avoid it, don't do it again twice. But nowadays, because of the ease of information sharing and the fact that we're all trying to do essentially the same thing, which is to invest in the share market, you can actually learn from other people's mistakes. And that's the golden thing, is if you can avoid mistakes others have already made by learning from them, you're already going to be standing on the shoulders of giants. So in today's video, we're going to go through two types of mistakes, really. The first category, I'll call it, are mistakes that are universally known, easy to avoid, and they're really more mistakes of inaction than doing something. But we're going to go through that. And then the second category of mistakes are just mistakes that I've made that I can tell you right now, you will probably make some of these mistakes as well. I'm sorry, it sounds controversial, but the reality is these are some mistakes that they're very emotionally driven, they're very, personality driven, that I just know you're going to make some of these mistakes as well. And I guess my aim is to try and give you some frameworks and some ideas and some thoughts, obviously, around how you can mitigate the downside risk from these mistakes, or the downside events that could occur from these mistakes. So avoid it going all wrong. So with that being said, let me also just say this is not financial advice. You should speak to a financial advisor. This is just me casually chatting. Right, let's get into it. So the basic category of universally well-known mistakes and things to avoid when it comes to investing are the following. Start as early as possible, be consistent, and have an emergency fund. Let me break it down. Starting as early as possible is such a well-known concept when it comes to investing, and you usually see it in some form along the lines of, hey, if you started at 20 versus if you started at 30 versus if you started at 40 and you invested the same amount of money, what would happen? Or it's usually done in the other way around, where it says if you have a target amount that you want to have when you retire, this is how much you would have to invest per month if you started at 20 versus you'd have to invest even more if you started when you were 30, and you'd have to invest a ridiculous amount if you started at 40. And it's this idea of the longer you spend investing and the more time you have in the market, the longer you have as an opportunity to gain those compounding returns, or the longer you have to compound your returns over time. And an example, let me do my own version of this, is say if you started when you were 20, you were investing $1,000 a month. I know, on the side note, I don't know how easy it is for a 20-year-old to get $1,000 a month. Let's just say you have 7% returns. In 40 years, let's say you want to retire when you're around 60, you will have $2.4 million. That's not bad. 30, you did the same thing, invest for 30 years now, 7% returns, you'll have 1.1 million. And then if you were 40 and you say you wanted to invest only for 20 years till you were 60, you'll get just under $500,000 at the end of it. And so here we can see you're investing the same amount of money at the same frequency, and you're assuming the same amount of compounding growth, and you end up with significantly lower amounts the longer you spend without investing. So the idea is start as early as possible. Now, starting early is great, but what you really want to do is start early and be consistent. Now, this is a big error that I made in my life, where I did start early, but I was in and out of the share market, and I was really doing more trading than I was actually investing. So I would buy things like childcare companies and mining companies and satellite companies. Some of these companies got delisted, and I would go into the market and I'd try and buy low and I'd try and sell high, and then I would really, what I was probably doing was buying high and selling low, and then getting disappointed, distressed about the share market, and then avoiding it altogether, and then coming back in and saying, no, I've got this time, and then still making the same errors that I made last time. So here the key thing is, if you are going to start investing, have the maturity to realize it's a consistent thing that you're targeting, and also generally try and avoid picking stocks, because that doesn't always work out that well. And here's the thing, if you are what I think you are, which is most people are somewhere between 25 and 35, you will have something called a superannuation account based here in Australia, or some kind of retirement account if you're watching from overseas. But the idea is, if that is the case, look at your superannuation, look at how big it is, and you will notice it kind of secretly got big without you noticing, 9.5, maybe up to 12.5%, going out of your pay every month or every fortnight into your superannuation. It gets invested, very quietly being done. You have some shares in your superannuation, because most superannuation accounts are exposed to the share market through international or domestic investments, and it just kind of grows. And if you look at how much money you've put into your superannuation versus how much money your superannuation is actually worth, you'll see there's a difference. It's worth more than you put in. And that's because of the returns you got from the share market. And this is the idea of investing consistently over time, small amounts, large amounts, whatever it is, but being consistent can really help you build up your investment portfolio. So once you've started early and you're being consistent, the other thing is you want to make sure you have an emergency fund, because you don't want to be in a situation where you have to take money out of the share market just to pay for everyday costs. So this is the idea of having an emergency fund, which might have 3 months all the way up to 6 months worth of your income in cash, in standby form, or in terms of your offset account if you have a mortgage. And the idea is, if something comes up, hopefully it doesn't, but if something comes up, like you lose your job, you have a major medical expense or major car expense or just a general major expense, you don't want to be in the situation where you have to take money out of the share market to pay for it. Because generally when you start investing, it's entirely possible for the first 3 to 5 years the share market will actually go sideways or down. And if you're in this situation where you have to get money out to pay for something, you'll be tempted to sell stuff from your shares just to pay for it. And that's unfortunate, because you're missing out on the opportunity to keep it in there to compound growth over time. So this is where the idea of having an emergency fund off to the side helps quite a lot, because then if something goes wrong, you've got a bit of cash on the side that you can dip into, use that, pay for the situation you're in, whether you've lost your job and you need to find new work, or you need to pay for some major expense. You can do that without taking money out of the share market. Because if you take money out of the share market, you might be taking it out at a loss, or you might be taking it out at a gain where you have to get hit with capital gains. And that's okay, obviously. Taxation is very important and you should follow those rules. But if you can avoid it till down the track, it's very handy. So this is where I would say, make sure you have an emergency fund that you can pay for those unseen events. So these 3 things: start early, be consistent, have an emergency fund so you don't have to take money out of the share market to pay for everyday things, are like well-known simple tenets of investing. Now let's get on to some of the more fun mistakes to talk about, should we say. And can I just say, having prior knowledge of these errors and lessons learned didn't stop me from still making them myself. So I come to you humbly saying, here are some things, but I fully expect you to potentially make some of these mistakes yourself. And part of what I'm going to try and do in the next segment is to try and give you some tips or tricks or frameworks to try and put in place to avoid the major downside of, or mitigate against downside effects of some of these mistakes. Because I don't know, I think almost some of us just have to learn from errors, and that's how we learn. Like, knowing this is a thing to avoid is not enough. We have to do it, we have to get it wrong, and then we're like, no, we should avoid that in the future. So the first one is FOMO investing, and I probably capture quite a few concepts in here, but the idea is investing either because you see something going up and you don't want to miss out on it, investing because you saw something else going up and you didn't invest at that time, and then you said to yourself, I promise I'll never make that mistake again, so then the next time something amazing comes up, you just invest as much into it. Or just, listening to what other people are saying. Someone says, hey, I just bought this stock and it went up 30%. You should do it too. And you're thinking mentally, oh, if I do the same, it might also go up 30% or it might even go up more. All these kind of things I've put into one category of just saying, avoid this at all costs, if possible. And the idea is, if you haven't done the research, it's very risky to start with. Secondly, if you're investing in individual stocks, that is risky. Like, make no mistake, whether it's BHP or some small miner that doesn't even have an operating plant, it's still very risky to invest in any one individual company, and this is where diversification comes into play. I guess the key thing here is try and avoid investing in something just because you fear missing out on the gains that might come. Because ideally, the framework you really want to have is the idea of long-term investing gains, that the gains that you're really expecting to see, you'll see over 10, 20, 30-year periods. And if you're expecting something to happen tomorrow or within a month or so, that might be quite a short time frame, and the probability of it going up in a short time frame is usually quite low. It doesn't mean it doesn't happen, and it doesn't mean it hasn't happened to your friends or your friends' mothers, cousins, uncles, and all of that. It doesn't mean that's unlikely to happen and hasn't happened. It just means it's risky, and you just got to be careful of it. Now, another little technique I use when I do want to try and mitigate against making these rash FOMO investing decisions is if I'm still really convinced that this is a potential opportunity and I think it might be an opportunity that I want to take advantage of. And this is what I mean by, I can tell you now, don't do it, but you'll probably still want to do it. One technique I use is minimum transaction sizing, meaning I just put in $500. Now, that's still a lot of money, I admit. But the minimum transaction my broker allows is $500. I put that in. I lose a lot of money in transaction costs, but if this is something that's going to be like a 10x bagger, why not? It's not a great idea. It's a small portion of my portfolio. But sometimes, if that's what you still want to buy and you still feel great about it, that's a great way. Is just limit yourself to such a small amount so that if it goes down, you're limited in your downside risk to just that small amount of $500. If it goes up, and hopefully it'll cover your brokerage because you're getting ripped off on brokerage if you just buy it for $500. But that's the idea. Again, like I said, not a good idea, not financial advice. Please don't do this. But if you're still really struggling and you still really want to buy something though, this is potentially a way to mitigate that downside risk there. Now, my next one is this whole idea of emotional trading. And this is what I've given it as a category, but I think there's official terms out there for this. But I see this as when you're buying and selling because you think the market is going up, or when you see the market is going down, you're really worried about it and you've stepped away from your long-term investment goals. If your long-term investment goals are to have a sizable portfolio in diversified index funds, then it makes sense to do dollar cost averaging along the way. But the risk is if you don't have that kind of mindset or that thinking, when the share market has a catastrophic failure of 20 or 30% drawdowns, you're going to be wanting to take your money out of the share market and preserve it and protect it. When really, if you're looking over a longer term time horizon, that drop will come back and recover. And what that drop is actually doing is it's giving you an opportunity to even buy more of the same ETF or particular company at a cheaper price. And this is where it's very handy to have high quality investments to start with, where when there is a market correction or when there is a downside event, you can position yourself to buy more of it at a cheaper price rather than panic and sell out. So this is, like I said before, dollar cost averaging is very handy, where you just commit to buying, and that helps manage your emotional side of investing, where you're worried about what's going on in the market, but you're focused on just investing consistently in. It also helps to have good quality investments. If it's a good quality company, then great, you can buy more of it when the value of the share market goes down. Or if you have ETFs, which are also good quality investments in that they're diversified, and you're investing in like some top companies overall, the share market goes down. It means it's cheaper for you to buy these good quality things. Yes, it will take time to recover, but if you've got a long-term time horizon, you've got that time, so you might as well buy in to a bit of that dip. But I'm not recommending that, but that's the idea, should we say. It's a fine line I have to follow here. So like I've said throughout this video, this is not investment advice, but there is a lot of value in simple concepts like having a long-term mindset in terms of your investing, dollar cost averaging, taking emotions out of your investing, not worrying about what your friends are doing, and investing in high quality assets like diversified ETFs or really high quality companies, if that's a path you really want to go down. That will really set you up. And also some of those initial ideas around investing as early as possible, investing consistently, and having an emergency fund. Like if you do all of this, my goodness, you will be standing on the shoulders of giants and you will be so happy. Or you can make a lot of these errors along the way and end up like me. All that being said, if you are interested in getting started on your investment journey, please do check out one of my videos before where I did talk about the 4 or 5 steps in getting started investing around brokerage, emergency funds, what to buy, and maintenance of your share portfolio. It's all there. Also, if you do want to have a chat with me face-to-face on Zoom or on Skype, feel free to check out the link below. We can set up a quick 15-minute discussion to bounce some ideas off. Obviously can't give any financial advice, but it might be useful for you to have a bit of a chat one-on-one with someone on that, and I'm happy to do that with you. And also, please consider subscribing, because I'm going to put out more videos on this topic of sort of getting started, covering off on things like emergency funds, and also just general things around budgeting, because I think that can actually help quite a lot when you get started on your investment journey. So I'll see you in the next video. Bye for now.